What's happening, I'm used to my camera being up there. What's happening, everybody? Welcome back to Acquire and Operate. We're buying, building niche vertical B2B SaaS businesses. We think it's blue ocean, great opportunity in the world right now. We're having a lot of fun. And today we are going to be jamming on a decision-making framework for optimal use of free cash flow. Table of contents. We've got a simple framework for allocating free cash flow. So we'll just kind of talk through it. And then we have an oversimplified example to bring it to life. And then we actually have just kind of like a summary, kind of decision-making framework that's followed by a table. That's basically like, are you observing kind of these metrics, these conditions? Okay. Because as you can imagine, context is king. So basically how to use your free cash flow really comes down to some dimensions about the business. So let's jump in. That sound good, Caleb?
What you gang?
All right. So we all know that cash is king. Cash is oxygen. It is the name of the game. And it's kind of funny because in our game, we're stepping into businesses that are stable, kind of enduring. They've got some free cash flow, which is just a sexy word there's a lot of nuance to it. And especially if you're not in SaaS businesses and you have to think about capital expenses, expenditures, working capital. There's a lot of things that you kind of need to throw back into the mix to get a really accurate handle on free cash flow. But so for us, just think like net operating income, profit margin, the money that makes it all the way to the bottom line. That's your free cash flow. And so for some quick context, like objective number one is the break even. So depending where you are on your journey as a SaaS founder, where you are on your journey as an acquirer and operator, you want to break even. And then lo and behold, for us fortunate few, you pick your head up and you're like, damn, we got more cash. Like we're doing better than breaking even. We've got surplus cash here. And then you have to make decisions about what to do with your cash. So obviously great question or good, problem to have. And usually there are kind of three usual suspects for what to do. Reinvest in growth. And that can be customer acquisition. That can be product development. That can be, different flavors, but the intent there is to grow the business. You can pay off debt. De-lever is the more technical term, or you can provide a distribution to yourself and to your investors. That's it. Those are the real three flavors. So the big question is like, all right, well, what the hell should I do? And so this is obviously a decision-making framework to kind of help you think through that. So as we had noted, there's a lot of nuance here, but I think the important thing is like we've got surplus cash, we can invest in growth, and then obviously you want to run that through some kind of RICE framework, some kind of something where it's like, cool, we know that the strongest ROI for this cash, or we have a hypothesis that the strongest ROI for this cash is going to be this thing, which means high reach, high impact, minimum or high confidence, low effort, and effort obviously equates directly to cost. So you can reinvest in growth, and what you'll kind of come to find by the end of this is like, you want to reinvest in growth in just about every situation. If your debt situation is beastly, like you've got high interest debt, which is probably not common. Like the most common debt in the mix in our context is SBA loans, which have a 10-year term and they, are 2 points above prime. So it's probably the most borrower friendly debt on the street. And so really the last thing you want to service that debt until you die. It's like those, I've got a cool 100K in student loans that's at like a 3.5 fixed % interest rate. I am not going to be proactively taking down that debt. And I hope I die with some of that debt. I guess I think now like it goes down to your, it's like the most unforgivable. Yeah, I'm like, I will service this debt. I will never delever because this is the cheapest paper. This is the cheapest paper ever. And I think that's less common. But then there is like this give back to investors thing, which is pretty common, right? Where it's dividends. Or for founders, it's like, I'm going to pay myself. I'm going to take some income out of the business, and that is
typically happens.
And that's a reasonable, but it's a reasonable thing, especially if you kind of come into it. It is, right? Well, and it depends, right? If it's like, are you taking a salary out of the business? Did you just get to a place where you can, for the first time, take some money out and maybe beef up your savings? So it depends, again, a lot on your context.
I would just want to always be reasonable, even in the sense of like, hey, you're the owner operator, and the IRS, they look at it as well as like, hey, you already have this salary. Here's some extra cash flow. While you could be reinvested in growth, you're just going to take it all right out of the business for your own personal reasons. Like, hey, let's be reasonable.
Well, and the tax man
more by reinvesting it.
And that's got to be part of your calculus, right? Where it's like, cool, exactly. I can pay myself a distribution and then I'm going to end up paying income tax on that, or I can reinvest in the business and kind of forego a taxable event until the future. And so it gets interesting. And another piece too is it depends a lot on the game you're playing. And this is a hard thing to distinguish, right? And I think a lot of times you have the constellation model, you have the permanent equity model, which is like or I guess one simple thing is like you come up with like a policy, and we'll get into this, but it's basically like, cool, we have very calculated growth investments that we want to make in the calendar year. After that, we have surplus cash. Okay, maybe this year it makes sense to pay a dividend or a distribution to our investors because they're under the expectation that there's going to be some income from this investment that they've done on the way to an exit, or that it's a pure play income thing, which is more of like, or kind of lends into like the constellation thing where it's like, and it's very analogous to real estate. It's like, we're going to buy this building, we're going to fix it up, we're going to introduce 100 new apartments, we're going to rent it up, and there'll be no vacancy, and we're going to collect rent month over month, and we're going to kick out an annual distribution, and it's just like an income generating strategy. Obviously, that's at odds with grow this thing to an extraordinary level, or we think that there's kind of gates. We want to grow it to here because it opens up a universe of buyers, and we want to do it at a growth rate that gives us a big premium on the multiple, which is probably, as we'll come to find, way more in your investors' interest. There's a very oversimplified example, but when you look at it, it's like, damn, yeah, I'm glad we didn't pay $250K in distributions. We just doubled the value of the business.
Why wouldn't you?
Yeah, right. So here's the oversimplified example to bring this to life, and then we'll go into a decision making framework that is like, is your ARR growing at X? Is your kind of debt, or is the nuance of your debt such that is, kind of very unfriendly? There's just different things where you can say, because the hard part, right, if it depends on context, is to figure out what is your context. So we need to give you measurables to be like, oh shit, this is where I'm at. And okay, this probably is a logical way to treat my free cash flow. So let's say your SaaS is doing 1.5 million of ARR and it's growing at a nice 20% year over year. And so that's, kind of median-ish growth. That 30% plus puts you in top quartile, and you can start to command a big premium. So you're like, all right, we got to get to 30% growth. We know that that's going to grow ARR by 30%, which is great, because now that no matter how you dice it, right, you're expanding kind of the top line, which gives you more surface area to drive a valuation. It gives you more surface area to capture profit on the way down the P&L, et cetera. But you want to, a 30% growth rate unlocks greater multiples and a higher valuation. 30% growth on 1.5 million of ARR is $450K in new ARR this year. You know that for every $75K you spend on marketing and sales, you generate $150K in new ARR. This is a friendly and oversimplified investment. Because damn, if your growth is coin operated like that, go baby, go. But anywho, so to hit your 450K growth target, you need to reinvest, or you need to deploy 225K of what we're assuming at this point is free cash flow. Cool. So you know what your growth target is, you know what the investment is required to get there, and you can back into an ROI from that. Impact on value. So currently your business is valued at 3.25 times ARR. So that means your $1.5 million ARR business, and we didn't get into EBITDA multiples, but those are highly relevant in our market segment, so we could have done it that way. But your business is 3.25 ARR, which means your $1.5 million business is worth just shy of $5 million, $4.875 million. After hitting 30% growth, your ARR is now just shy of $2 million. So you're at $1.95 million. And oh my goodness, your multiple just went from 3.25x to 5x. So before you chose to invest, so you've got that 225K. You could give it to your investors. Hey, cool, happy days, right? Or you could pay down your loan. Okay, maybe that made sense too. But you chose to invest in growth. And so before investment, the business was worth $4.875 million. That was the enterprise value, assuming no debt, I guess, in this example. After investment, you've got almost $2 million in ARR, and you've expanded the multiple to 5x. It's now worth $9.75 million. So all to say that 225K you just invested in growth just doubled the value of your business. I'm pretty damn sure investors would have been like, thank God you didn't distribute that money. Good God, you just made this thing twice as valuable.
That's it. So I would absolutely start there. And then to your loan example, going back to the high interest, if you can get that interest back in, because if you think about it, you get rid of that high interest loan, that's revenue that's technically back in month over month. So if there is a high interest loan, just get that out of the way and then get back into reinvesting in growth. But unless you're in the real estate business, maybe hold on distributions.
Yeah. Well, I think the thing about debt, right, is like debt kills you. Debt is a killer. So if
just
you miss debt,
dude.
Yeah, if you miss debt payments, the bank comes and says, you missed debt payments. What are you going to do? Oh shit, you keep missing debt payments. All right, we're going to repossess the business. Okay, you still owe us money. We're going to now, if you signed an SBA or did a personal guarantee for an SBA loan, we're going to come take your shit. So the thing at the end of that tunnel is a bankruptcy. So basically, if there's debt in the mix, the business becomes less anti-fragile. less durable over time. So again, it depends a lot on the terms of the debt and that stuff.
Yep.
And I think from an investor perspective, it's like either invest in growth or de-risk the business, because
Yep.
we don't know what's going to happen in the economy, blah, blah, blah. It's an election year, blah, blah, blah. So you're either going to grow the thing or make it more durable.
And you see a lot of companies de-risking like the last few years. Granted, layoffs are a part of that, and it kind of sucks, but you see a lot of companies de-risking. A lot of them can't even afford their debt that they've been servicing because the revenue hasn't been up.
Yeah, totally. Or a lot of leverage buyouts in private equity where it's like, oh man, we had a variable interest rate on this thing, and now the debt payments are so beefy, we got to lay off people so we can make our debt service.
Yep.
It gets
Real
scary
tricky.
quick. Yeah. All right, so we're going to bang through these ones pretty quick. So here's like the free cash flow allocation decision-making framework. So there's a few kind of high-level things. You've got assess the current business needs in the stage. So it's like, what's the growth rate look like? Is the growth picking up? Is growth deaccelerating? Is growth plateauing? Just kind of get a sense on what your momentum is. Obviously, you need to evaluate key metrics. What's our ARR and growth rate? What's our profitability and margins? What does customer retention look like? Unit economics. And obviously, or if you're only getting to a place where you start to measure this shit when you have free cash flow, you're a lucky human. So you should probably have a handle on all this stuff by the time you get here, but you're just kind of taking stock. So we're going to assess the current business needs and stage. We're going to evaluate our key metrics. We're going to look at the available growth opportunities very much through the lens of ROI. So if we put money here, and obviously you hopefully have historical data, you have base rates you can draw from, or you're kind of aspiring to hit benchmarks. It's an objective relative point of view, which we've spoken about ad nauseum. Then you want to think about the leverage and debt service requirements. Oh man, is this a high interest loan? No. Okay. What's the term on this loan on a relative basis? What's our debt to equity ratio? Okay. Now you're starting to figure out like what kind of impact can we have on reducing the risk profile of the business. Investor expectations and timing. So ideally this should have been done on the front end, but it's like you have a hold period. You've established some type of policy around distributions or dividends, which is, I kind of had alluded to one, like the most basic one is if there's surplus cash flow that we can't find a better place for, which is ideal per the example, like you want to plow into growth as much as you possibly can, or plow into improving retention, or plow into doing a lot of stuff. But it's like, oh shit, we did all these things and we honestly don't know what to do with this other 100K. Okay, that's surplus free cash flow, and that would be cool to do it, just a little tickle for investors, keep their head in the game. And then risk management and economic environment. So it's like, all right, are there new competitors that have come in that are eating everybody's lunch? Are we concerned about a down cycle that's going to hit our target market, et cetera, et cetera? That was rapid fire. So the actual table, right? So the table is probably the most useful thing. It's at the bottom. And basically there's a quantifiable thing. For the most part, it's quantifiable. It's like a stage or metric. And I'll just walk through a couple of these. So you've got stage metric, growth focus, delevering focus, and investor distribution. So that could be an investor focus. So if ARR is growing greater than 30%, pour gas on it, baby. Reinvest in growth. And again, continue, like your job is to just constantly fixate on the lowest hanging fruit and invest there and generate high ROI type scenarios. As it relates to delevering, if it's friendly debt, it's an SBA loan, you got a 10-year term, you're meeting your debt service coverage ratio, you're feeling really good, it's growing 30%, leave. And investor distributions, investors are going to love you a lot more if you reinvest in growth and, create enterprise value than they will if you just throw them, a 20K check or something. So that's one example. Now, let's say ARR growth is sub 30% or it's in structural decline. In this example, it's like, all right, is there anything we can do on the growth side? Like you want to or basically make the most out of the lifetime value of your customers. So can we make any improvements to retention? Are there elements of product market fit that we could tune up? What can we do to kind of reinvigorate growth? That's got to be the first priority. You could think about delevering at this point. It's like, we've reached a certain saturation point in the market. We had eyes on our top 2,000 logos and we've acquired 80% of them, that would be a happy day. And then it's like, all right, so it's our job now to just hold the fort, put our elbows out, defend the market share that you have. And then maybe you start to play with delevering, and then even less, maybe you start to think about distributions. And so the table goes on. And the other attributes, just to tease you a bit, are net profit margin. So if the profit's north of 30%, you've got a lot of free cash flow. There's more opportunities. If it's sub 30%, that's another thing. High leverage, which in this example is measured by debt to EBITDA, which is a very conventional way to do it. But if you're operating in a high leverage environment, which is your debt to EBITDA ratio is north of 3x, you got to kind of navigate accordingly. And then the last couple of things are high leverage, low leverage, favorable debt terms, high investor pressure for returns, stable or saturated market, and then volatile economic conditions. And again, with that as kind of like the prompt to help you figure out what your context is, we've got some inputs around how you could think about growth, how you could think about delevering, how you could think about investor distributions. Cool.
Oh yeah.
Free cash flow. God, it even sounds sexy. You know, it's the name of the game. It really is.
Yep.
Everything's about it's
How'd you
capitalism,
find
right?
that?
It's like it's about asset ownership, and then it's about the free cash flow that those assets produce. That is the game our society plays. Full stop. So you can make an asset more valuable by growing the revenue it produces, and therefore more of that making it down to the bottom line. But the name of the game is to own assets that kick off free cash flow. Full stop. All right, playa. Same time, same channel next week.
Same time, same channel. For the love of the
For the
game.
love of the game, yeah. What happened to my laser beams, dude? Whoa, that's not great.
It took it all. And
Man, not great.
Are you using the next camera this time?
Oh yeah, I'm using my internal camera. Damn. All right, well, we'll just imagine the laser beams. All right, buddy.
All right.
Pleasure to share the field of battle with you. I'll catch you next week.
Yep, next week. Peace.
Cheers.